Good morning, ladies and gentlemen. I'm very pleased to take this opportunity to talk about the resource investment climate for some metals. And also, I will introduce some about the Han-King businesses. So I'm going to talk about, first, as I said, about resource investment climate. Then I will quickly cover the Han-King business strategies. And following that, I will introduce Han-King development plans for all iron ore, nickel, and gold sectors, showing as an international mining player what Han-King will do in the next few years. And in the past decade or so, China has been the primary driving force for the booming of global mineral industry. And its appetite to consumption of mineral commodities has pushed the prices of most metals to historical highs. According to various international agencies, China GDP will slow down from its double-digit numbers in the past decade, but will still remain in the 7 to 8% range for a long time to come. So its fundamentals for GDP growth still remain. Although China GDP was only 7.8% last year, positive momentum in China should be sustained, and forecasting China GDP growth return to 8% plus in 2013. So long-term expect strong demand growth from urbanizing populations, not only in China, but also in India, Indonesia, and other Asian countries. So urbanization drives steel consumption intensity, and China reached in the range between 500 to 600 kilograms per capita, and still has room to grow due to its immaturity in steel recycling, and as developed countries have. In addition to China, steel per capita intensities have great potential to grow in India and Asia. These nations expect to increase in steel industry intensity progressively, but not peak before 2040. Cash cost has been rising very rapidly in all major iron ore producing regions. Increases of production cost in some of the countries are even tripled in the past decade. This will again elevate the pricing platforms in the global scale. In the meantime, the commodity prices have increased sharply in the last 2 decades. In the real terms, the iron ore prices has gained almost 4 times as high as before, and nickel increased 3 times more. It is very intriguing to observe that commodity prices have increased sharply in the second half of the 20th century, in contrast to the decline in the first half of the same century. However, although gold price has fluctuated in a very high level in history, but its peak occurred in 1980s in real term. So gold price has a lot of room to increase given the fact of global economic weakness, volatile financial markets, and also some local unstable geopolitics. I'm talking about nickel a little bit. Nickel is a metal that is relatively rare in the Earth's crust, and nickel price has been suppressed in the past few years because of significant increase in supply in the form of nickel pig iron (NPI). From a long-term market view, shortage of the nickel supply appear to be of more reality. Some experts forecast that a balance between supply and demand is achieved only if another 500,000 tons annual new nickel capacity is developed in 2019 and 2025. Nickel price does not look great in the next 3 to 4 years in short term, from the short-term perspective. But it will gain strong support in the mid-long run. So without new nickel extraction facility being added, a structural shortage will occur after 2017. In order to invest more in nickel industry, promise of high prices, high incentive prices is necessary. According to the China customs, import of laterite nickel ores in 2012 were 52% coming from Indonesia and about 47% from Philippines. The China import of nickel ores increased 20 times in the past 5 years. Statistics in the past years show that the very high nickel NPI gained rapidly in the market share, while low nickel NPI decreased drastically in its market share in the last 3 years. The NPI production increases sharply in the past 3 years. The price of nickel has been suppressed, fluctuating between $15,000 to $20,000 per ton. So this trend will not change significantly in the next few years. So I'm going to briefly talk about Hanking business strategies. Hanking is strategically placed itself to controlled diversification in carefully selected mineral commodities. We will focus on only iron, nickel, and gold, which form a portfolio of mutual complement and also high growth margins to fit to long-term market incentives. Hanking is also active seeking international opportunities. We have already successfully diversified into China, Indonesia, and Australia. In China, we will focus on the Anshan-Benxi iron ore belt, where most of our current mines are located. And this belt hosts about 1/3 of the China total iron ore resources. Australia and Indonesia will be our major destination areas for future expansions in nickel and gold businesses. Hanking has moved very fast in the past couple of years in metal diversification and internationalization. We have successfully acquired a world-class nickel mine in Indonesia and a promising gold property in Australia. This property will form the core of our near future development and growth. So let's move to the iron ore development planning. Hanking is the largest non-state-owned iron ore producer in the northeastern China. The company has over 18 years of successful operational records, and our core competitiveness is very low cash cost, which is only about half of the China national average. Hanking has achieved very strong financial performances. In the past 3 years, the compound annual growth rate in revenue is 46%, while the CAGR of EBITDA is 83%. As I said, the core competitive edge of Hanking is a very low cash cost, which is contributed by several factors, such as very low shallow ore hostings, very simple magnetic processing, optimized logistics, new innovations, and proximity to steel mills. All products can be sold within an average radius of 35 kilometers from the mine sites. Hanqing cash cost was 252 RMB per ton, and which is, as I said, only half of the national 500 RMB per ton. The global average CIF cost is about $77 per ton, and China average is about $80 per ton, while Hanqing has a cost only about $49 per ton. So Hanqing is positioning itself in the very low end of the cost curve. Hanqing has invested intensively to expand our current iron ore mines. We have two major mines going to be expanded very quickly to each to 3 million tons annual processing capacities. So based on our current plan, our target is to reach about 10 million tons per annual processing capacity by the end of 2015. The focus of Hanqing operations is to enhance our low cash cost advantage. We will use efficiencies of scale to scale, to maximize the efficiencies. We also maximize the use of new technologies, such as the high-pressure rolling technologies, and we will continue to implement very strict safety and environmental protection measures. Now I'm talking about the nickel mines. I just mentioned that last year we completed the acquisition of a laterite nickel deposit in North Konawe, southeastern Sulawesi, Indonesia. This deposit contains total nickel metal of 4.8 million tons at a grade of 1.37%. By resource, this property is the second largest nickel deposit in the world, so providing Hanqing with a huge development potential. This is a producing mine, with an annual production of 1 million tons of nickel ore at this point. One of the mine, KS, has already shipped 100,000 tons of ore last year. A temporary port has been built also last year. Another major mine is called KKU, which is also being constructed. It will start to produce in a few months. Hanqing will invest a total of $245 million in the next 5 years to expand the mining capacity and also build a new smelting facilities. We plan to expand the mining capacity to 2 million tons next year, 3 million tons in 2016, and 4 million tons by 2017. In the meantime, we will build the smelting facility with a nickel metal production capacity of 10,000 tons by the next year, 20,000 tons in 2015, and 40,000 tons by 2017 in the form of NPI, the nickel pig iron. Now I'm going to talk about the gold development plans. Hanqing has just completed the acquisition of a gold property in the southern cross of Western Australia. It's about 360 kilometers east to Perth, with very good infrastructure conditions. have railroads, highways, and airports available. Only about 35 minutes flight from Perth and only about 2 hours of drive to Kalgoorlie. Electricity is also accessible from the state grid, and the mine has abundant water supplies and a few inhabitants and very low land costs. Acquisition of Southern Cross operations add another dimension for Hanking to create more values to its shareholders. The table in this slide lists a number of acquisitions in Australia reported in the past 8 months. It shows that the acquisition cost per ounce for the Southern Cross operations is only a fraction of others. The low acquisition cost minimizes the risks of Hanking to enter a new country. Southern Cross operations have 14 deposits discovered around the more than 2.4 million tons annual CIL processing plant, with a total of JORC comparable gold resources of 2.4 million ounces. The average gold grade is about 3.6 grams per ton. All gold resources in these deposits are fairly easy to process. The conventional CIL processing plant can recover over 90% of the gold from the ore. Southern Cross operation is located in the famous gold rich belt in the very typical gold-containing greenstone formations. The package of exploration permits covers over 960 square kilometers in area, along with the 150-kilometer long belt. Historical accumulated production of gold is over 10 million ounces, and regional potential for discovery of new gold resources is excellent. This slide just shows you the overall settings of existing mines, administration and housing facilities, processing plant, and also the tailing ponds. So this mine has everything for us to start the production right away. Here's our plan in the next 5 years. Hanking will focus on those deposits which can be mined in open pits. This will minimize the initial capital cost and also shorten the mine's construction period in cycles. These mines require about $60 million before the mine can be developed to feed full capacity of the processing plant. And all future development investments can be self-supported from their operational cash flows. So total of discounted net cash flow from these few mines is estimated about $150 million, with a total recovered gold over 620,000 ounces. While these mines in operations and underground mines will be designed and developed and scheduled to extend the mine life over 10 years. So that's pretty much the 3 sectors for Hanking to develop in the next few years. And finally, I just give you some summary what our value proposition is. Regardless of market volatility, low cost has always been Hanking's key value driver. Hanking remains focused on promising and optimizing its operational cost structures. We will maintain our own low operating cost advantage, and will continue to grow as a low-cost producer. And Hanking delivers value to shareholders through the sustainable value creation model, which is low cost, high growth, low risk, and high returns. And thank you very much.